session of the WIRC, which is related to CARO and Schedule 3 Companies Act 2013 reporting. So before we begin, I request everyone please place their hand on heart for Institute motto.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्द्वैता 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 एतद्द्वैता.
Welcome back. So in these sessions, we are going to discuss about practical aspect in implementation of amendment to Schedule 3 of the Companies Act 2013 and critical issues and reporting under CARO 2020. So it is really a very important topic we have selected for today's sessions and really need-based topic. So before we begin, we are fortunate to have presence our dynamic chairman of WIRC, Murtuza Kachwala. So I request him to address the audience.
Thank you, Saurabh. Let me first welcome today's speaker, CA Bhupendra Mantri ji. Bhupendra ji, thank you very much for accepting our invitation and joining, and really accepting to share your valuable knowledge with the participants. Let me recognize presence of CA Shweta Jain, Secretary WIRC, and let me thank CA Saurabh Ajmera, CA Gautam Lat, and CA Ankit Rathi for organizing such a beautiful program, the much needed topic. And I should also thank all the participants. I am given to understand we got more than 400 registration for this session. So thank you very much. Thank you to all the participants for joining us today. This year, the theme at WIRC is lead, that is leap towards excellence, achievement and development. And let me only touch upon one important aspect today, that is excellence, and that too related to the topic. When we talk about a company audit, whether it is a private limited or a public limited company audit, there are so many multiple factors these days. Now, the first and the important is, what is the turnover? Is tax audit applicable? Second is the internal financial control reporting applicable? And of course, since we are talking about CARO today, so I am assuming that CARO will be applicable to that particular client. And then we need to look at the Schedule 6 requirement. But other than that, also there are multiple accounting standards. And friends, if I were to talk only about a fixed asset or a property, plant, equipment, whatever we call, then I need to look at the depreciation standard, and depreciation not only as per Companies Act but also as per the Income Tax Act, because that also you have to calculate for like your tax audit. Now the second thing is, of course, if there are like a lot of large additions and if there is borrowing for that, then whether applicability of borrowing cost is there, and then the applicability, if there is an applicability of intangibles and impairment, okay, and of course deferred tax to that extent of the difference between the depreciation will be there. Now, so my basic thing is, it is important to know various aspects of the accounting standard, the Companies Act, the CARO, and also the tax audit requirement, and then only we will be able to decide, like on the looking at the total population, what are the opening block, what are the additions, what is the deletion, what is the closing block, and now how do I select the samples? First is how many samples. Second, how many will I do judgmental and how many will I do statistical? And then how do I apply the analytic procedure to select the samples of the additions or depreciation calculation or whatever it is, and then a checklist so that it completes everything. And of course, while doing my vouching or checking, I'll also see whether any capital expenditure has been charged to revenue or whatever. So there are so many aspects of it which we'll have to cover, and hence it becomes important that we have comprehensive knowledge, irrespective of how much is the turnover of the private limited company or how much is the fees. Even if the fee is 10,000 rupees, we need to comply with all of these, the accounting standards if they're applicable, the company law, the Companies Act requirements will have to be fulfilled, the CARO requirement will have to be fulfilled, and tax code requirement will have to be fulfilled. And same is the case whether we talk about a 269 SST loan taken given, Companies Act angle, or X or Y or the related party angle. And if we talk about the purchase vouching again, the 48(2)B and the related party. So there are so many of them which will have to be covered. So really, the company audit is becoming more and more difficult, and hence it is very important that we keep ourselves updated. At WIRC this year, to achieve excellence and bring about efficiency in our work, we have like a lot of goals, but the two important goals which will impact today's topic. And one is like at WIRC, we're trying to create so many different refresher courses on as we speak. In the month end, we are starting a refresher course on Ind AS, and in June first week, we're starting a refresher course on accounting standard again. So various of these refresher courses to equip our members so that they're technically updated. But again, on the technology front, we are organizing certain courses, and in the month of May, we are coming up with again use of IDEA software. So the data will be given a free license of IDEA will be given to you a demo license, and you can use the demo license for 30 days, and you can work on directly on the data. So data analytics, and which will also help you in selecting of sample on procure to pay and order to cash and fixed asset and all of those as well. So similarly, like we are trying to create some tools or utilities which can be made available to the membership free of cost. We are trying to tie up with software vendors where the software is going to be made available to the membership at a much discounted rate. And of course, we are also coming up with various shorter and longer duration courses on the IT side, technology side. We did one on Fusion of Excel and Tableau. We did one on CAT tools. Like I said, something on IDEA, and then there are longer duration courses also. So, friends, I think I have said enough, and I'm looking forward to a lot of participation from you on various programs, events, and activities of WIRC. Happy learning to all of you. Over to you again, Saurabh. Saurabh, over to you. Thank you.
Thank you, Murja bhai, for sharing all the goals and objectives of WRC. And I can say that we are really doing proactive work at a WRC level for all our members. So it's really a good thing. And now moving ahead, I'd like to introduce our today's session faculty, Bhupendra Mantri sir. He is a practicing fellow chartered accountant, DISA, BCom, LLB qualified, and senior partner at Kalani and Company. He is a founder executive member at Kalani and Affiliates. It's a network. He is responsible for developing new subject avenue in the firm since 2010. Since then, having hand-on exposure on Ind AS, IFRS, revised Schedule 6, XBR, new companies law, valuation, financial due diligence, FEMA, etc. He is also heading IFRS Ind AS consulting practice of the firm. Presently working on IFRS Ind AS implementation and training project and audits. He is also heading implementation of internal finance control in the firm. So he have very good experience related to the topic. So welcome all of you with this. Sir, over to you.
Yeah, thank you, Saurabh ji. Thanks, Murtuza sir. Now, coming to the today's topic, and before that, I would like to thank WIRC for giving me this opportunity to basically learn that what are actual practical aspect and implementation of amendment to Schedule 3 in the financial statement for the financial year 21-22, as well as to deal with the critical issues and reporting under CARO 2020. I say that while dealing with or while speaking on this particular topic, I am also learning so that means that if I have to prepare, I have to certainly look for a lot of practical aspects in the implementation of all these subjects, and that certainly gives a lot of learning to me also. So now with this background, now coming to the various practical aspects as well as the implementation of the recent amendments to the Schedule 3 in the financial statements for the financial year 2021-22, as well as on CARO. Now coming to the my presentation. If we see my presentation would basically deal with both the subjects simultaneously, because if we see a lot of amendments which are there in the Schedule 3 as well as the CARO 2020, which was earlier issued by the Ministry of Corporate Affairs and now applicable for 2021 to 21-22 financial year. My screen as well as presentation is visible, sir?
Yes, sir. Yes.
Okay.
Yes.
Yeah. So if we look into the these two aspects, then we will find that there are a lot of reporting which are there on behalf of the management in the financial statements as well as in the CARO 2020, which are similar and they are on the same subjects. So therefore, what I have done in my presentation is that wherever the relevant reportings are there, both in the Schedule 3 as well as in the CARO 2020, I am dealing with all these subjects simultaneously, and not in a way that first I will be dealing with the Schedule 3 amendments and then CARO 2020. And I am sure that this would make the discussion more relevant. So now coming to the next slide, that is practical aspect of next slide. I think there are some issues. Yeah. So if we see these amendments, which are effective from the first day of April 2021, that is effective for the financial year 2021-22, all the three divisions have been changed, have been amended by the Ministry of Corporate Affairs. And these divisions are Division 1, that is related to the financial statements for a company whose financial statements are required to comply with the Companies Accounting Standards Rules 2006. So that means the companies who are following accounting standards, they are basically following the Division 1 of the Schedule 3. Then Division 2, which are financial statements for a company whose financial statements are drawn up in compliance of the company's Indian Accounting Standard Rules 2015. So those companies who are basically following Ind AS, companies which are listed companies or the companies having net worth of more than 250 crores. So these companies are basically following Ind AS. So amendments are there in Division 2 also. And then Division 3, where financial statements for a non-banking financial companies whose financial statements are drawn up in compliance of the company's Indian Accounting Standards Rules 2015. So NBFCs who are following Ind AS are required to prepare their financial statements as per Division 3. So in all these three divisions, there are amendments which we shall discuss. Then what are the purpose of amendments? Basically, when we will go through the amendments, you will find that these are to bring more transparency as well as the enhanced disclosure in the financial statements. And of course, these will add value to these financial statements. And some of the amendments, as I have discussed, are to align with the CARO 2020. If we go through the entire presentation, my presentation is basically primarily based on amendments in the Division 1 of the Schedule 3, and then all relevant changes in other divisions are also discussed simultaneously. And what I have tried to do is, of course, whatever amendments are there in Schedule 3, they are discussed, and then I have tried to basically include those provisions first, which are in CARO 2020 discussion, which are basically which are basically changed as compared to the CARO 2016. So more discussion would be there on the additional disclosures as well as the revised disclosures in the CARO 2020 as compared to the CARO 2016. Yeah. So if we see the entire CARO 2020, these are the major heads of the amendments in the formats of financial statement of Division 1, 2, 3 of the Schedule 3 of the Companies Act. In equities and liabilities, in all Division 1, 2, and 3, there is change in the format of the balance sheet. There are changes related to the disclosure in the promoter's shareholding. Then there are changes related to the borrowings and trade payables. So these changes are there in all the Division 1, 2, and 3. And apart from that, then there are changes in Division 2 and 3, which are basically the division related to the Ind AS, formats of financial statements related to the Ind AS. So changes are there in the statement of changes in equity, in equity share capital disclosures, other equities, as well as there are changes in the other financial liabilities. And if we look for the changes in the asset, then you will find that in all the Division 1, 2, and 3, there are changes in the format of the balance sheet. Then disclosure requirement of property, plant, and equipment. Then disclosure requirement of capital work in progress. Intangible assets under development, intangible assets, security deposits, trade receivables. And in Division 2 and 3, there are changes, there are amendments with reference to the other financial assets. And in all these divisions, Division 1, 2, and 3, there are various additional disclosure requirements which are related to the title deeds of immovable properties, then investment property, property, plant, and equipment, and intangible assets, then loans to promoters, directors, KMPs, related parties. So disclosure requirements are there. Then disclosure requirement to related to the Benami properties held under the prohibition of Benami Property Act 1988. Then how do we use the borrowed funds and share premium? So those disclosure requirements are there. Then willful defaulter, if any particular company has been declared as willful defaulter by the bank or the financial institution, so those disclosures are there. Then relationship with struck off companies. So there are certain disclosure that what transactions are there with the struck off companies. So those changes, amendments are there. Then compliance with the various layer of companies as per section 186. So disclosures are there. Then certain ratios are also required to be given under the financial statements. Then disclosures are there related to this scheme of any scheme of arrangement which is there. And if you see the statement of profit and loss, then there are disclosures related to the grants or donations received. Then CSR expenditures, how the CSR unspent CSR expenditures are there, need to be disclosed over there. Then details of cryptocurrency as well as virtual currencies are also required to be disclosed. And then there are disclosures related to the undisclosed income in the statement of financial losses. So these are basically brief summary, or you can say the major heads of amendments in the format of financial statement. And if we go through the CARO 2020 and compare it with the CARO 2016, then also there are various changes which were actually not there in the CARO 2016. So there are changes related to the property, plant and equipment in intangible assets, about the maintenance of record of intangible assets, and about reporting on the revaluation, reporting on the title deeds of immovable properties in the prescribed format, as well as reporting on the proceedings under Benami Transaction Prohibition Act 1988. Then in inventories, there are certain minor changes as to the disclosure of various discrepancies. Working capital limit, also there are requirement related to the verification of quarterly returns or statement filed with banks or financial institutions. Then loans, advances, guarantees, securities and investments which are given by the company. So again, there has to be bifurcation in our reporting under CARO. There has to be a bifurcation of aggregate loans to be given to the subsidiaries, JV, associates and others. Then there are reporting requirement related to the evergreening of loans. Then loans repayable on demand to the related parties. Regarding disputed statutory dues, certain scopes of reporting have been widened to cover basically all statutory dues instead of the certain limited statutory dues as in CARO 2016. Then undisclosed income, transactions which are not recorded in the books of accounts have been surrendered or disclosed as income during the year. So those reporting is there. Then about loan taken by the company, there are various disclosures. There were various reporting requirements under CARO 2016, which have been substantially changed by CARO 2020, where all loans are now covered. There is reporting requirement related to the willful defaulter. Then how do we utilize the loans from short-term basis as long-term for meeting the long-term objectives, long-term assets. Then funds taken to meet obligations of subsidiary, JV and associates. There are certain reporting requirements related to this particular point also. Then if any loan which has been taken on the pledge of securities held in the subsidiary, joint venture as well as associates. So these changes are there. Then related to frauds also, there are certain revised reporting as to the fraud by the company or any fraud on the company. Then there are additional points also related to the reporting under section 143.12 in form ADT4, as well as reporting of whistleblower complaints are also there. Apart from this, there are changes related to the reporting for internal audit systems as well as internal audit carried out by the any internal auditor of the companies, which may be external or as well as in-house internal auditor. Then NBFC related changes are there. Certain changes are there with reference to the reporting of cash losses. Then resignation of statutory auditors. If there is any auditor who has resigned, so then also the incoming auditor or the new auditor have to write those facts about as well as the reasons about the resignation of the auditor. Then there are disclosures related to the uncertainty in meeting the liabilities of the company in next 1 year. Then disclosures related to the CSR as well as anything which has been reported in the CARO report of subsidiary companies or other group companies. So that has to be considered while making a CARO report for the CARO report for the purpose of consolidated financial statements. So there is no separate CARO report for CFS, but in CARO report itself, we have to mention that are there any qualifications or adverse remark by the respective auditors in the CARO report of those group companies. These are the clauses where there are no changes. So I will not be touching up much on these changes while discussing the entire presentation, because we all are very much aware about these changes. But still, if there is any discussion or any questions which is required to be dealt with, we can certainly deal with this. deal with those questions. So property, plant and equipment. So what record or property, plant and equipment is required to be maintained, and what are the reporting requirements? There is no reporting for deposits as per provisions of section 72 to 76, whether those provisions have been complied with or not. So that reporting is also no change. Then reporting about the cost records, undisputed statutory dues. Then how the funds which has been raised through IPO, FPO or private placement have been utilized, or whether the requirement related to section 42 and section 62 of the Companies Act have been complied with or also not changed. Then disclosure requirement related to the related party transactions. So reporting by the auditor in CARO, that has also not been changed. And non-cash transactions. So these are certain points which are not changed under CARO 2020, and they are same as they were there in the CARO 2016. So now coming to the applicability of the CARO 2020. So the Companies Act, the Companies Auditors Report applies to all companies, including foreign companies, as defined in section 242 of the Companies Act, except the following. So the banking companies are also for auditor is not required to report under CARO for banking companies, insurance companies, section 8 companies, then one-person company and a small company under section 285, as well as private companies who are actually satisfying certain conditions. And here it is important to note that who are the small companies, because there are certain change of the limit for the purpose of small companies, which were recently there wide notification dated 1st of February 2021. So small company means a company other than a public company, paid up share capital of which does not exceed 50 lakhs of rupees, which has been recently increased to 2 crore rupees with effective from 1st of April 2021. So for the financial year 2021-22, if any company which has paid up share capital of 2 crore will be considered as small company. And so these are basically conditions which are to be satisfied. Both the conditions are required to be satisfied, and turnover of which, as per the profit and loss account for the immediately preceding financial year, does not exceed 2 crore rupees. 2 crore rupees was basically the earlier limit. Now it has been increased to 20 crore rupees with effect from 1/4/2021 by the same notifications. So any company which has, as of now, paid up capital of 2 crore rupees or whose turnover in the immediate preceding financial year have not exceeded 2 crore rupees, 20 crore rupees, will be considered as small company. If so, therefore, if any company which is falling into this criteria of a small company, the auditor is not required to report as per CARO 2020. And then what are the conditions related to the private company if for non-applicability of the CARO 2020 is that private company which is not being a subsidiary or holding company of a public company, having a paid up capital and reserves and surplus not more than 1 crore rupees as on the balance sheet date, and which does not have total borrowings exceeding 1 crore rupees from any bank or financial institution at any point of time during the financial year, and which does not have a total revenue as disclosed in Schedule 3 to the Companies Act exceeding 10 crore rupees during the financial year as per the financial statement. So for the purpose of non-applicability, all these three conditions need to be seen. If any of the conditions, suppose the turnover exceeds reserves and surplus exceeds more than 1 crore, capital and reserve and surplus, but other conditions are satisfied, then also the CARO will be applicable. So if all these three conditions are there, these limits are not crossed by the private company, then only CARO will not be applicable. Otherwise, CARO 2020 will be applicable on the private limited company. A private limited company, and it may also be noted that where any company which is covered under the definition of small company, then even if these limits are exceeded, since it is covered by this small company definition as well as which is actually exempt without any condition, therefore CARO 2020 will not applicable on that small company. Now, if we see these amendments in the CARO 2020, the new CARO 2020, as well as the amendments in the Schedule 3 of the Companies Act with regard to the formats of the financial statements, there are a lot of amendments where the auditor will require to consider the other standards on auditing, and that is very important. Because see, disclosure is one aspect that yes, the company in its financial statements as well as the auditors in the CARO 2020 report have given their reports. So that disclosure as well as the reporting by the auditor in the CARO 2020 is one aspect. But there are various disclosures where the auditor need to think whether as per these relevant standards, SA 700, SA 701, 705, SA 706 or 710, as well as the SA 501, 550 on 501 on audit evidence, 550 on related parties, 560 on subsequent events, and 570 on going concerns. So auditor need to consider provision of these standards also, and if there is any requirement, or if the auditor is of the view that because of reporting under these CARO under the CARO 2020 as well as the disclosure requirement as per the Schedule 3 in the financial statements of the companies, whether it makes any whether the auditor is required to judge whether there is any requirement of modification in the auditor's report based on this. So I would come to various examples while actually discussing on the various amendments, that yes, there may be certain items which auditor need to consider for the purpose of auditing, for the purpose of giving in the for the purpose of making its main report. So I would like to basically dwell upon those issues as and when various relevant provisions comes. So with this backgrounds, now coming to the various amendments which are there under the companies, under the division, under the Schedule 3 as well as the CARO. So the first amendment which is there in the Division 1, and that amendment is basically related to this rounding of requirement in the balance sheets. So earlier, if we see this Division 1, the rounding of requirement says that the companies may round off their financial statements into nearest hundreds, thousands, lakhs or millions, or nearest lakhs, millions or crores of rupees, depending on the level of their turnover which was there in the financial statements. Now this word used was may under the Division 1 earlier has been replaced by the word shall. So that means the rounding of requirement have now been is now a mandatory requirement for all companies who are preparing their financial statement as per Division 1. In Division 2 and Division 3, already it is a mandatory requirement. Now in Division 1 also, the requirement is made mandatory regarding rounding off. So these are the basically, this is the basically table that where the less than 1 crore rupees is the total income. So here the amendment is also there with reference to the total income. Earlier the word was turnover. So the turnover includes only the turnover of those goods and services in which the company deal with, whereas the total income may also include the other incomes. So that word turnover has also been replaced by the words total income. So if any company is having total income less than 1 crore, 100 crore rupees, that can round off, that have to round off the financial statement either into hundreds, thousands, lakhs, or millions, or decimal thereof, or the companies who are having turnover of 100 crore or more have to round off their financial statement into lakhs, millions, or crores, or decimal thereof. So these are the changes related to the rounding of the financial statement in the Division 1. Now coming to the another change which is there related to the reporting of promoters holding. So in promoters holding, amendment is there in all the divisions, Division 1, 2 as well as the Division 3, wherein the promoters are required to disclose, the company is required to disclose in the financial statements this particular disclosure, that what are the shares held by the promoters at the end of the year and what are the percentage change during the year. One have to disclose the promoter's name, what are the number of shares which are held by the promoters, and then percentage of total shares, and then what is the changes during the year. So for comparative purpose, the company should also disclose these details for the previous year, and then only that comparison will be more relevant, because until and unless one has not disclosed the previous year figure, disclosing the percentage change would not be more relevant. So the guidance note, basically guidance note on these schedule 3 for all the divisions suggests that previous year disclosure should also be there in this promoter shareholding disclosure requirement. And then what are the promoters? Promoters are basically those promoters who are defined as per the Companies Act 2013. So basically promoters whose name has been given as promoters in the annual returns and other documents are the promoters for the purpose of these disclosure requirements. And then these details shall be given separately for each class of shares. So if any company which is having the equity shares, preference shares, and then there are various categories of preference shares. So for each class of shares, this disclosure requirement is required to be given by the companies. Now coming to the another disclosure that is related to the borrowings. So here this disclosure related to the borrowing is basically the first disclosure is related to the Division 1, because in Division 2 and 3 already the borrowings are disclosed as short-term borrowings. In Division 1, the current maturities of long-term borrowings, these were basically earlier disclosed under the head other current liabilities. So whatever disclosures, whatever current maturities of long-term borrowings means the borrowings which have been taken for more than 1 year, and any maturity is there for these borrowings which is there within 1 year of the reporting date. Those borrowings are basically called as current maturities. Now the Division 1 says that these borrowings need to be classified as short-term borrowings instead of classifying them as other current liabilities. And similar change is required to be done for previous year disclosure for the financial year 2020-21. Then another disclosure is related to the if the borrowings from banks and financial institutions has not been used for the specific purpose for which it was taken, the company shall disclose the details of where they have been used. So this is an important disclosure that wherever any borrowings which are basically taken for a specific purpose and the management has not used that borrowing for that specific purpose, so a liability or a responsibility is casted upon the management itself, on the company itself, to disclose that yes, we have taken these borrowings which has not been used for the respective purpose for which it has been taken. So suppose if any borrowing which has been used, which has been taken for the purpose of working capital requirement and has been used for the purpose of construction of any fixed assets or for the construction of any plant and machinery, so then management have to disclose that this have been actually used for construction of plant and machinery and not for the purpose of working capital requirement. Now see that what are the implications. Suppose management itself says that these funds have not been used for the purpose of for the specific purpose for which the same have been taken. So what are the implications? Moment this particular balance would go to the banks or to the financial institutions or to other stakeholders. So bankers, financial institutions, they will ask for, if you have not used this particular uh, fund for the specific purpose. So why the same should not have been taken back from you? Because these are not as per the sanctions which has been issued by the bank or financial institution to the company. And moment such reporting is there that utilization of fund is not there as per the specific purpose, then what are the duties of auditors? So the auditor's duty is not only just limited to get it reported under this under the financial statement as well as in the CARO 2020. Auditor need to consider whether this should be shown as current liability now. Suppose there is a long-term loan which has been used somewhere else, and moment there is default or moment there is breach of the conditions of the loan, then whether the same should be disclosed as current liability because there is a breach of condition, and the sanction letter says that moment there is breach of condition, it should be basically immediately be payable to the financial institutions or the bank. Or is there any other liability which is required to be accounted for by the company? And if that liability has not been accounted for by the company, maybe in the form of penal interest, say there is a 2% penal interest, and as per the sanction letter of the bank or financial institution, and that liability is not provided by the company in the financial statement, even though the company accepts that these have been used somewhere else. So whether if that liability is not being provided by the company, then whether a qualification is required to be there, and a modified report as per SA 705 is required to be issued by the auditors. So these are various questions which an auditor has to take on which an auditor have to take a judgment about these implications on the reports itself, not only on the financial statement and CARO 2020, but on the report itself, auditor have to take a judgment. Now coming to the various disclosure requirement under various disclosure requirement under CARO 2020 for these loans. So if we see the CARO 2020, then there are disclosure requirements about the default in repayment of loans. So clause 3(9) of the CARO 2020 says that whether the company has defaulted in repayment of loans or other borrowings or in the payment of interest thereon to any lender. So here it is about any lender. Under CARO 2016, the requirement was related to financial institutions, banks, government, or uh, due to debenture holders, but not for any lenders. So here, all lenders, if there is default in repayment of loan to all lenders, then that is also required to be disclosed, apart from the financial institutions, banks, and governments. What is the disclosure requirement? One need to disclose that what is the nature of borrowing, including debt securities, what is the name of lender, lender-wise details to be provided in case of default to banks, financial institution, and government, and then amount not paid on due date. So what is that amount which has not been paid, whether this amount is principal or interest, so that has to be mentioned. Then what is the number of delays which is there. So if during the year itself, suppose within the year the loan or the installments have been paid, but within the year there are delays, so that delay is also required to be reported over here in the CARO report. Then another disclosure requirement is whether the company is declared as willful defaulter by any bank or financial institution or other lenders. So this is again a new reporting requirement which is required to be there about the willful defaulter. And what is willful defaulter is again a question wherein RBI has issued certain guidance that yes, this particular borrower should be deemed as willful defaulter, wherein the RBI has said that if any of the borrower who has actually taken a loan for a particular and specific purpose, and thereafter it has not paid that loan, even though the particular borrower has capacity to make the payment. So there is ability to make the payment, but the payment has not been made. So that is one condition where a particular borrower can be declared as willful defaulter. And apart from that, the RBI guidelines says that if there is any siphoning of the funds, funds have been utilized somewhere else as compared to the specific purpose, and if there is any sale or removal of the asset of a particular of the removal of the assets which have been offered as security to the bankers or the financial institution, then also the banks can declare a particular borrower as a willful defaulter. Now coming to these provisions, if we see, first of all, what course of action then auditor have to take, that they have to first see that or they have to first obtain a confirmation or certificate from the company's bank that whether the company has been declared as willful defaulter by any bank or financial institution or any other lender. Apart from that, the public domain data can also be obtained where if suppose any of the borrower has been declared as willful defaulter. And not only that, see, if management is required to disclose or the auditor is also required to disclose about the defaults in payments made, then at the same time such disclosure would ultimately give an idea to the stakeholders or to the bankers that why this particular borrower should not be declared as willful defaulter. So maybe that presently a particular borrower is not declared as willful defaulter, but once you disclose in the financial statements that yes, these funds have not been utilized for the specific purpose for which the same have not been taken up, there are chances that the banker may later on declare a particular borrower as willful defaulter. So that is one aspect. Then again, there are disclosure requirements with reference to reporting requirement by the auditors, whether the term loans were applied for the purpose for which the loans were uh, obtained, and if not, the amount of loan so diverted and the purpose for which it is used may be reported. So here again, suppose a loan has been taken for the purpose of construction of a particular property, plant and equipment, and the same have been used for other purpose. It may be long-term purpose always as well as short-term purpose, but has not been used as per the sanction of the government, sanction of the lender. So in that case, the auditor is required to report it. So for this purpose, basically the auditor have to see the nexus between the funds received from the bank as well as the funds, how the same have been utilized by the company. And basis that, auditor need to take a judgment whether the long-term funds which have been received by the borrower have been utilized for the specific purpose or not. And here, any loan which has been taken in the previous year, and suppose in that year that loan was invested into the surplus funds, and now in this year have been utilized. So utilization of that loan is also required to be seen, that whether it has been used for the specific purpose or not. So it is not only the current year's loan, but also the previous year loan which has been taken by the company and utilized in this particular year also need to be seen by the auditor. Then there is new reporting requirement with reference to the funds raised on short-term basis and have been utilized for long-term purpose. So here, suppose any working capital loan which has been taken by the company have been utilized or not for the long-term purpose, say for the purpose of construction of the fixed assets. So that has to be reported, and where the same have been utilized have to be reported. Then whether the company has taken any funds from any entity or person on account of or to meet the obligations of its subsidiaries, associates or joint ventures, and if so, details thereof with the nature of such loans, nature of such transactions and amounts in each case covers, and it covers loans, advances as well as investments. And if the sufficient cash from operations and investment activities are there with the parent companies, then probably such reporting may not be required. But one has to always see that where from the funds are actually coming, whether they are out of the available funds with the company or they are out of the funds taken from someone else. And if the same has been given to the any subsidiaries, associates or joint ventures, and that nexus is proved, then a reporting requirement is there that yes, these are the funds which has been taken by the company and the same have been given by that company either as an investment in the shares of subsidiary, associate or joint venture, or as an advance or loan to that subsidiary, associate or joint venture. And if it is so, then it has to be reported over here in the CARO 2020. Then next new reporting is whether the company has raised loans during the year on place of securities held in subsidiary, joint venture or associate companies. So here also it is about loan taken by the company, which though may have been utilized somewhere else, but that loan has been taken by giving the securities of subsidiary, joint venture or associate companies. That means those investments which are there in the subsidiary, joint venture or associate companies uh, have been given on place, and then a loan has been received by the company. And if there is any default in repayment of these loans, then uh, that is also required to be reported over here. So there are two disclosure requirements. One is whether they have taken loan or not, and then another is if they have taken such loan, whether there is any default in repayment of such loan or not. So that is one aspect which they have to auditor have to report. Now coming to the now coming again to the disclosure requirement under schedule 3 division 1 as 1, 2 as well as 3, because all these disclosure requirements are there in the all the all the divisions of schedule 3. So here the reporting requirement is there related to the trade payables in the notes. So there are reporting requirements in the trade related to the trade payable on the format of the balance sheet, on the front page of the balance sheet, as well as in the notes. So these disclosure requirements are there in the notes, wherein one is required to report the trade payables as per this particular format. And if you see this format, one has to basically first do an aging analysis of the various outstanding payable to the payable to the other parties as trade payables, and then these are the particulars. One has to report the trade payable outstanding to the MSMEs, then others which are not disputed, and then disputed dues payable to the MSMEs as well as the others. So these are the 4 line items which are required to be disclosed, and then similar information shall be given where no due date of payment is specified, and in that case disclosure shall be from the date of the transactions. So here it is important that what is due date. So if there is any agreement between the creditor as well as the company that yes, payment shall be made say after 30 days of the invoice, so due date will be considered from after 30 days, and then aging analysis is required to be made. So suppose if there is any invoice which has been raised on say 31st March 2021, and 30 days due date is there, so by 30th April 2021 payment was required to be made by the company to that particular trade creditor, and as against this the payment has not been made till 31st March 2022. So since the due date was 30th of April 2020, the trade payable which is outstanding as on 31st March 2022 shall be disclosed under this column of less than 1 year and not more than 1 year. If we count it from the date of invoice, it may be more than 1 year. So here this particular aspect have to be taken consideration. So basically, what are the challenges? Challenges are like, suppose there is an ERP which is there where these trade payables are recorded, and somehow in the ERP due dates are missing. Suppose due dates are not there, or suppose small and mid-sized companies, they are maintaining their books of accounts on some other softwares and not on the ERPs. So there also these facilities of recording the due dates in the books of accounts may not be there. So the challenge is that for each outstanding invoice, you need to find out that what is the due date of payment, and then this particular aging analysis is required to be done. So this is one challenge. Then if we see challenge in this disclosure, we see that there are these 4 rows about MSME, others, disputed dues MSME, and disputed dues others. So one of the contradiction which is there in these items is that if we see the format of the balance sheet, then disclosure is trade payables to micro and small enterprises and others, whereas in this disclosure it is MSME. That means it includes micro, small and medium enterprises also. So here there is a conflict between the balance sheet main page as well as notes which is required to be disclosed. So basically, to deal with this particular contradiction, what one can do is that this row 1, micro, small and medium enterprises, can be classified or can be categorized into the 2 rows. One is micro and small, and other is to medium enterprises. And then third row can be there related to the others. So this is one solution to deal with this particular contradiction. So there basically the balance sheet as well as the balance sheet total of micro and small as well as the total which will be given in the notes will be tallied with each other. Otherwise, it will not be tallying with each other. Now, another disclosure is with reference to the unbilled dues. Unbilled dues means where you have received the services, but bills have not been received from the respective trade payables. So that is also required to be disclosed separately. And one more challenge over here is that if suppose there are certain trade payables which are not yet due, so where that has to be disclosed. So one practical suggestion is that one more column is required to be added over here, where we need to disclose that amounts which are not due. So suppose there is any invoice which has been issued on 31st March of 2022, which has been received by the company on 31st March 2022, but payment terms are that the payment will be made after 30 days. So the payment to such supplier will be due on say 30th April. So that means 30th April 2022. That means this trade payable is not yet due. So this will not come in any of the 4 columns: less than 1 year, 1 to 2 year, 2 to 3 year, and more than 3 years, because these columns are related to the creditors which are due. So to deal with this situation, one additional column can be given of the trade payables which are not due, and then the total will tally with the trade payables which are outstanding and tally with the trade payable which are actually reported in the balance sheet. The another issue is with reference to the classification of dues as disputed. So here also this term disputed has not been defined in the schedule 3. So how we shall classify a particular trade payable as disputed is again a question. So wherever suppose there is any, so disputed means there is disagreement between the 2 parties. So whether such a dispute has been taken to the court or not is another issue. But suppose there is any trade payable and that company has disputed, some amount that yes, we are not going to pay this particular amount because of this and this reason, and that correspondence is there between the company as well as the supplier. So such dispute will be, such amount may also be treated as disputed dues, even though there is no uh, what you call there is no court cases in that particular case. But at the same time, one need to see that if any due which has been taken as disputed, whether the company is actually required to account for the same as liability or not. So that decision also is required to be taken by the company and seen by the auditors. Now coming to the another disclosure requirement, that is with reference to the reporting of non-current assets. So here basically the schedule 3 says that if there is any change in the property, plant and equipment, particularly by those companies who are following revaluation model of the AS 10 or Ind AS 1, Ind AS 16. So those companies, if they revalue their property, plant and equipment, and that change is more than or equal to 10% of the total value of the property, plant and equipment of a particular class. So in that case, a disclosure is required to be made in the financial statements. But here one thing one need to take care of is that if we see AS 10, accounting standard 10 on property, plant and equipment, the para 81 requires that there has to be a reconciliation of the value of property, plant and equipment at the beginning of the year as well as at the end of the year, and that reconciliation should state that what are the changes on account of revaluation. So and then there is no limit of 10% as per AS 10. So accordingly, in the notes related to the property, plant and equipment, AS 10 as well as the Ind AS 16, both of these standards do not prescribe any limit. So the guidance note suggests that whatever is the practice of disclosure as per AS 10 or Ind AS 16 is there, that should be basically consistently followed. So this particular change of revaluation, change related to revaluation, does not impact any of the present disclosure requirement in the financial statements. So this is one change. Then another change is related to the other non-current assets, wherein the schedule 3 says that the security deposits should be now shown as other non-current assets. So earlier these securities deposits were shown as loans. So as compared to that, now these are required to be shown as other non-current assets. So that is one change which is there in the schedule division 1 and 2. Now similar requirement related to the aging analysis related to the disclosure of trade receivables. So under trade receivables, this particular aging schedule is required to be given, wherein the trade receivables are required to be disclosed as less than 6 months, 6 months to 1 year, 1 to 2 years, 2 to 3 years, more than 3 years, and then total. So almost all those issues which were there related to the trade payable, the one issue was related to the due date, that when what should be the due date of payment and how this aging analysis should be done from the due date. That issue is there. Then dispute. What is the meaning of dispute, which we discussed on discussed for trade payable. The similar issue would also be faced while disclosing the trade receivables. Then unbilled dues. So anything which we have supplied, but for which bill has not been issued by us. So for that, disclosure is also required to be made separately. And here, when anything which is unbilled, please mind that if it is unbilled, it will not be due, because as a seller of the goods, you yourself has not billed, so it is not due. So it should apparently come under the column not due. So yes, then there is again an issue related to the disclosure of one more column, that where trade receivables are not due to the company. So almost all those challenges which I discussed during the discussion of trade payables are also there while reporting the aging analysis of trade receivables. But apart from this, uh, one thing which actually I forgot to discuss about trade payable was, suppose there are trade payables which are more than 3 years, or they are basically outstanding for outstanding to be paid for more than a considerable period. Then the management as well as the auditor, if it is a case of trade payable, have to think of or have to take a judgment whether such trade payables are required to be recorded as income or not, or maybe that these are now actually not payable. So that judgment have to be taken up by the auditors, and the process of balance confirmation would certainly help, because moment a particular trade payable as well as the trade receivables, this particular aspect will also be applicable for trade receivables. So the balance confirmation process should ensure that actually the that particular creditor or that particular trade receivable or the debtor uh, also is of the view that yes, this particular amount is payable to the company or is required to be received from the company. So that is one aspect which one need to see. And certainly the balance confirmation process will uh, will help the management as well as the auditors to identify whether a particular trade receivable or the payable is actually there or not, or whether there is any adjustment which is required to be done by the companies. So these disclosures related to trade receivables were basically for division 1. Now coming to the division 2 and 3, that is related to if we see the changes related to the trade receivables, then these changes are slightly different as compared to the changes which were there for division 1. So here the trade receivable will be classified as trade receivable considered good and secure. Then trade receivables which are considered goods and unsecured. Then the row 3 is trade receivables which have significant increase in the credit risk, and then trade receivables where credit of those trade receivables have been impaired. So these are the 4 sub classification which have to be done. And then if you see the aging analysis, then of course columns are almost same, but there are 6 rows which are required to be given. One is trade payable receivable, undisputed trade receivables considered good, then undisputed trade receivables which have significant increase in credit risk, then undisputed trade receivables where credit is impaired, and then again the 3 disclosure for disputed trade receivables which are considered good where significant increase is there in the credit risk and where credits are impaired. So basically these disclosure requirements are there to align with the Ind AS 109, wherein they say that uh, the management or the company need to assess whether for the financial assets there is any significant increase in the credit risk, as well as whether there are trade receivables where there is whether there are credit impaired trade receivables. So moment such these disclosure requirements from the India's perspective are also there in the schedule division 2 and 3. But if you see India's 109, that does not mandate that company that it should perform the credit risk analysis for individual debtors. For individual assessment of credit risk, there is no requirement under India's 109, though there is requirement that yes, if there is any specific trade debtors or trade receivables where there is a credit impairment, then yes, that assessment is required to be done. But for significant increase in credit risk, individual assessment is not required to be done. So if any company have done individual assessment with reference to the significant increase in the credit risk, then this disclosure is required to be done. But if such assessment is not there, then the company have to disclose such trade debtors as considered good only, and not as if there is any significant increase in the credit risk. So far as credit impair is concerned, such credit impairment is always there when there is significant deterioration in the credit worthiness of any individual or any entity. So as per India's 109 also, the companies have to assess whether there is significant deterioration in the credit worthiness of a particular debtor, and if it is so, then that particular debtor can be classified as credit impaired. And though they have mentioned that undisputed and disputed issue which we have discussed will also be applicable over here, apart from the other issues which we discussed for trade receivables in division 1 as well as the trade payables. So these are the disclosure requirement for trade payable and trade receivables. Now coming to the other disclosure requirements related to the title deeds of immovable properties not held in the name of company. So there may be various situations where a company may be having the various immovable properties in the financial statements, but their title deed are not in the name of that company. And if it is so, then these disclosures are required to be done. One is description of the item of the property. So that description means it may be a property, plant and equipment. It may be an investment property. It may be a non-current asset held for sales, or it may be an item of inventory or other assets. So any of the description may be there. So this particular disclosure is not only for property, plant and equipment, but for other immovable properties also. So this one need to consider. Of course, in CARO there is certain contradiction which I shall discuss while discussing the relevant clause for CARO 2020. Then we need to disclose, the company need to disclose the gross carrying value of that particular property, as well as in whose name the title deeds are there. Because if it is not in the company's name, then in whose name the title deeds are there. Then whether title deed holder is a promoter, director, or relative of the promoter, director, or employee of the promoter, director. So if it is so, because sometimes there is possibility that a promoter, director, or their relative may have contributed certain property, certain immovable properties to the company, and that contribution is basically there as a, say, equity for which shares have been issued, and there are possibilities that uh, respective formalities of getting the registration done in the name of the company have not been done. So the holder of such title deed may be a promoter, director, as well as any of the relative. And if it is so, then that that fact need to be disclosed. Then property is held since which date? So when the property have been accounted for in the books of accounts have to be disclosed over there. Then one need to also disclose that what are the reasons for uh, not being held in the name of the company. So that is also required to be disclosed over here. So uh, see, in all these cases, there may be number of reasons for which title deeds may not be registered in the name of the company, and these reasons may be like sometimes the documents may be under preparations, and sometimes the registration process may be under progress, and uh, suppose if these reasons are there for every year. Suppose last year a property was there and the reason was that registration was under process. So in that case, the companies, the auditor need to see that whether such registration is even today under process, and if it is so, that then how it is possible. So there may be certain other reasons also that the registration is not under process, but there may be certain disputes. So auditor have to actually properly inquire into the matter. If the reason like registration is under process is continued for more than 1 year, so proper inquiry should be made, and the auditor need to assess that whether such reason is proper or not. And apart from this, there may be certain reasons uh, uh, for not getting the title deed in the name of the company, which we shall discuss, of course, while discussing this particular clause of clause 3(1)(c) of the CARO 2020, wherein also the reporting is required by the auditor that whether the title deeds of all the immovable properties other than the properties where the company is the lessee and the lease agreements are duly executed in favor of the lessee, disclosed in the financial statement, are held in the name of the company, and if not, provide the details thereof in the format given below. So almost same format is there, which we discuss while discussing the disclosure requirement as per Schedule 3. So almost same format is there. Now coming to the other reasons, that what are the other reasons which may be there. One of the reason is that like there is conversion of partnership form or LLP into the company, and because of that conversion, the all properties have been now vested into the company. But again, uh, the properties, the title deeds have not been transferred in the name of the company. So that is one of the reasons. There may be demerger of the companies for which suppose out of the demerger, out of the one company, there are now 4 companies, but the properties have not been, title deeds of the properties have not been transferred to the respective companies. So in that case also, there may be possibilities that the registration is not, title deed is not in the name of that particular company. So here questions come that what is the title deed? So title deed is basically any document which constitute the evidence of the ownership. So any document of, say, any transfer deed, any sale deed, or any document of convincing. So those may be considered as title deeds. Here, while auditing, some of the cases may come where the title deeds have been mortgaged to the banks or the financial institutions, and in that case, the auditor may not be able to actually see the original title deeds at the time of its audit. But in that case, the auditor should obtain the confirmations from the respective banks or financial institutions or the other lenders that yes, the title deeds are there with them, or the auditor may also verify the online records of the state. These days, various states have updated the online records, or they have digitized the online records of the various immovable properties, and wherein they also record that whether these title deeds are mortgaged to the other banks or not. So if there is any such record, then that record may also be verified by the auditors. In some of the cases, there may be possibility that title deeds are lost. So in that case, proper certified copy of the title deeds should be taken by the auditors, and auditors should also see whether any FIR, first information report, have been lodged by the company to the respective police department, and auditors should obtain the copy of such FIR, and he should also take the relevant management representation letter in this regard, because and the respective reporting may also be there in the CARO report that yes, such title deed could not be verified for so and so reasons. Now coming to the another disclosure related to the revaluation of property, plant and equipment and intangible assets. If we see the disclosure requirement, I have mentioned the disclosure requirement in the earlier slide, which says that where the company has revalued. So this is the disclosure requirement under Schedule 3, and then we will come to the reporting requirement under CARO 2020. So here in Division 1, the disclosure requirement is related to the revaluation of property, plant and equipment only, and in Division 2 and 3, the disclosure requirement is also there related to investment property and intangible assets. So here this disclosure, the requirement is related to whether such revaluation has been done based on the valuation by registered valuer as defined under Rule 2 of the company's Registered Valuers and Valuation Rules 2017. So basically, this section 247 requires that the companies, wherever there is any valuation as per the Companies Act, then that has to be done by the registered valuer, and that registered valuer should be registered with the Insolvency and Bankruptcy Board of India. So auditor need to see that whether such registered valuer is actually registered with the respective with the IBBI or not, and such disclosure is also required to be done in the balance sheet by the company also. Now coming to the requirement of CARO, which says that whether the company has revalued its property, plant and equipment, including right of use asset or intangible assets or both during the year, and if so, whether the revaluation is based on the valuation by a registered valuer, and specify the amount of change if change is 10% or more in aggregate of the net carrying value of each class of property, plant and equipment or intangible assets. So here also it is a new reporting requirement which was not there in the CARO 2016. So, but if the change is more than 10% only, then this particular requirement is there. Now coming to the another disclosure requirement, which is related to loans or advances granted to promoters, directors, KMPs, key managerial personnel, and the related parties as defined under Companies Act 2013, which are either repayable or demand, or without specifying any terms or conditions or period of repayment, then the following disclosures will be made. That is, what is the amount of loans or advance in the nature of loan outstanding, and what is the percentage to the total loans and advances in the nature of loans. So first we have to see that such loans or advance, particularly the advance which has been given to these parties, are in the nature of loans or not. And if it is in the nature of loan, then disclosure requirement is there as per Schedule 3. So if any advance has been given, say for supply of goods to these parties, so such advance will not be covered over here. But auditor need to see that whether such advance is in excess of what actually the goods are to be received from that particular party. And if it is in excess, then such excess advance can be treated as in the nature of loan. So that one has to see. Then such disclosure requirement should also be there for previous year in the financial statements. And this categorization which have been given in the table should be for amount of loan or advance in the nature of loan or outstanding, as well as the percentage. So all these aspects should be, all these disclosures should be given in the financial statements. Now coming to the disclosure reporting requirement under the CARO 2020. So if we see CARO 2020, clause 3.3f, that is related to the loan repayable on demand to the related party. So this clause says whether the company has granted any loans or advance in the nature of loans, either repayable or demand, or without specifying any terms or period of repayment, and if so, specify the aggregate amount, percentage thereof to the total loans granted, aggregate to aggregate amount of loans granted to promoters, related parties as defined under section 276 of the Companies Act 2013. So similar disclosure requirement which are there in the financial statement is also there in the CARO 2020, which has to be reported by the auditors. So this is one change. So far as section 185 and 186 is concerned, I will not be discussing on this, as already the similar disclosure requirement were there under the CARO 2016. So now coming to other CARO reporting requirement in respect of loans given by the company. So here clause 3.3a is there, which is basically a new reporting requirement. Apart from that, clause 3.3e is there, that is related to the evergreening of loan. That is again a new reporting requirement. But there are three clauses which were actually which are not included here in my presentation, are clause 3.3b, which are basically loan granted. The auditor have to report whether they are not prejudicial to the interest of the company or not. So that reporting requirement is still there under clause 33B. Then clause 33C is there, that is related to the whether the repayments of loan are regular or not. So that disclosure requirement is still there in the reporting requirement is still there in the CARO 2020. And then if loans are due for payment, whether these loans are overdue for more than 90 days and reasonable actions have been taken by the company or not. So that disclosure requirement is also there in the CARO 2020. And apart from these disclosure requirements, these are the additional disclosure requirements which are coming into my slide presently. So that is whether during the year the company has made investments in or provided any guarantee or security or granted any loans or advances in the nature of loans, secured or unsecured, to companies, firms, limited liability partnership or other parties, and if so, whether during the year the company has provided loans or provided advances in the nature of loans or stood guarantee or provided security to any other entity, and if so, indicate that what are the aggregate amount during the year and the balance outstanding at the balance sheet date with respect to such loan or advances, guarantee or security to subsidiaries, joint ventures and associates. So that is one segregation. And to parties other than subsidiaries, joint venture and associates. And it is about all loans. So basically all loans uh, have to be reported in these two categories. One is to subsidiaries, joint ventures and associates. Another is parties other than subsidiaries, joint ventures and associates. So this is one reporting requirement wherein one have to state the factual position. And then another requirement is related to the evergreening of loans. So whether any loan or advance in the nature of loans granted which has fallen due during the year has been renewed or extended, or fresh loans granted to settle the overdues of existing loans given to the same parties. So suppose loan has been due in the March 2022 and the company as well as the loanee as well as that party, and it is all parties, it is not about only related parties, only KMP, only subsidiary, joint venture or associates, all parties are covered over here, and the company has agreed in the March 2022 itself that no, now it is not required to be paid and you can pay it after 1 year or after 2 years, after 5 years. So moment such agreement is there, this particular loan, this particular agreement may fall into this terminology evergreening of loan, that the company actually do not want to take this loan from the borrower and rather it is trying to support that particular borrower by not taking this particular money, and this has to be reported over here. So please mind, a detailed scrutiny will be required. Where loans outstanding are there, please make a detailed scrutiny and see whether there is anything which is there that as per terms and conditions loan was required to be taken today, required to be repaid in this year but have not been repaid by that particular borrower to whom the company have lended the money. So a close scrutiny, detailed scrutiny will be required to actually see that is there any evergreening of loans. Now another requirement are related to, so again I am coming to the Schedule 3 disclosure requirements. Schedule 3 disclosure requirements. So here the disclosure requirements are there with regarding capital work in progress and the intangible assets under development. So here aging schedule is required to be given for capital work in progress as well as intangible asset under development in these buckets: less than 1 year, 1 to 2 year, 2 to 3 year, and more than 5 years. So basically, while doing this particular aging, one need to see that when a particular capital work have started. So aging would start from that particular date. So suppose a particular capital work in progress is there for last 5 years, and in every year there are certain expenditures which have been incurred. So the amount which is lying in the capital work in progress would actually uh, uh, be classified, would actually be put into all these buckets. So for more than 3 years, suppose out of the 10 crores, 2 crore have been incurred in initial 2 years. So that would come in the more than 3 years. And then you need to see that out of the remaining 8 crores, how much have been incurred in the less than 1 year, in the 1 to 2 years, in the 2 to 3 years. So in all 4 buckets, that particular 10 crore which has been incurred in the capital WIP will go. And it is not that from which date that capital WIP is pending. So if it is pending for more than 3 years, so entire 10 crores should not go to the more than 3 years. You need to actually bifurcate bucket wise. So that is one thing, but which one need to consider, company need to consider. Then aging is required to be done for projects which are in progress and the projects which are temporarily suspended. So projects in progress are those projects where there is continuous work which is going on. So that classification is required to be done. But see, sometimes certain projects may be temporarily suspended because of the specific reason, because of say nature of that particular asset which has been constructed. Say there is a hydropower plant which is under construction, and because of the heavy rains in hilly areas, say project is suspended for 1 month or 2 months, and thereafter automatically, as and when such rains are not there, the project is resumed. So such project will always be considered as project in progress only, not project temporarily suspended. But if any project which has been temporarily suspended and management is of the view that, and where the date of carrying out that project is not yet decided, again carrying out that project is not yet decided, then that project will be considered as projects which are temporarily suspended. And in such projects and any such capital WIP, all projects need to be basically classified as these projects in progress as well as projects which are temporarily suspended. And one need to then another disclosure which is there is for capital WIP and intangible asset under development is whose completion is overdue or has exceeded its cost compared to its original plan. So there one need to see that in how much time these projects will be completed. So following CWIP and IAUD completion schedule shall be given, that the same shall be completed in less than 1 year, 1 to 2 years, 2 to 3 years, or more than 3 years. So suppose there are two things. One is that the cost of the project have been exceeded, and another is the completion is overdue. It was about to complete in 3 years only, whereas already 3 years have expired, and it is going to be completed say in another 3 years, another 5 years. So that is the project overdue. So one need to give a complete detail that when what is the exceeded cost of such project. So suppose 100 was the original cost, original planned cost, and the company have already incurred say 75 crores, 90 crores, and you still see that for completing this particular project, say another 50 crore will be required. So 90 is already incurred, another 50 will be required. So total project cost will be 140 as compared to the 100 which was the originally planned. So here management has to disclose that the original cost have been exceeded or will be exceeded uh, for completing this particular project. And now suppose the project was to be completed within 2 years, but already 2 years have expired, then management have to actually disclose that in what period this particular project will be complete. So auditor have to actually see that what are the minutes of the board where what decisions are being taken, and accordingly correlate it with the disclosure which are being given. And suppose the management have not taken any action or have not discussed all these uh, exceeded cost as well as the overdue of the project in their board meetings, then uh, then auditor have to actually judge whether such disclosure is proper or not. And suppose such disclosure are not given because of non-action by the board of the company, by the management of the company, then auditor need to consider whether appropriate reporting is there, reporting is required in the audit report also, as per SA 705 or as per SA 706, where one can disclose the other matters also. So these are certain things which one need to consider while reporting capital work in progress. So these are the formats, in fact, you can see. Now another disclosure requirement is disclosure of details of Benami property held. So basically, if there are any proceedings which are pending or which have been initiated against the company for holding any of the property under this Prohibition of Benami Transaction Act 1988 and rules made thereafter, then these disclosures are required to be made. Details of such property, amounts thereof, and details of beneficiaries. Then if property is in the books, then the reference to the items in the balance sheet, that where this has been disclosed. And if property is not there in the books, then that fact shall also be disclosed along with the reasons, because there may be sometime a situation where the company have actually purchased certain property in Benami name out of the undisclosed income, and the same have not been disclosed in the books. So those reasons should also be disclosed over here. And where there are proceedings against the company under this law, and an abater of the transaction or as the transfer, then the details shall be provided that who are the actually transferor of these properties and all that. Then what are the nature of the proceedings, what is the status of the same, and what is the company's view on the same. So basically, for complying with all these requirements and for verifying these things, the auditor have to actually see the records of, say, legal expense, see the records of contingent liabilities also, as well as auditor should obtain and make necessary inquiry from the respective persons of the management whether any such notices or any such proceedings have been initiated by the respective authorities against the company. And once such disclosure is there in the financial statements, then the auditor is also required to make certain disclosure under the CARO 2020 report, where it says that whether any proceedings have been initiated or are pending against the company for holding any Benami property under the Benami Transaction Act, that is Prohibition of Benami Property Act, and rules made thereunder. If this name has been changed, in fact, I didn't point out that the name of the act, Benami Transaction Prohibition Act 1988, have been changed to the Prohibition of Benami Transaction Act 1988. So that is why I am pronouncing a different name over here. So auditor need to disclose whether the company has appropriately disclosed the same in the financial statements or not. So if it has not been appropriately disclosed, that means if these disclosures are not given over here, then auditor have to give the same over here. And if there is any reasons that why can't this disclosure be made over here, then the auditor have to give those reasons in the CARO report to be issued by. So these are certain disclosures related to CARO reporting under by the auditors. Then again, coming to the schedule 3, whether the company has borrowings from banks or financial institutions on the basis of security of current assets, then disclose the following. So here again, very important disclosure from the point of view of management as well as the auditors. So these things are required to be disclosed, whether quarterly returns filed by the company to bank or financial institution are in line with the books of account. So that is one thing. And if not, that means they are tallying with the books of accounts or not. And if not, then reconciliations and reasons of material discrepancies. That what are the reasons? And this disclosure requirement under Schedule 3 does not mention whether it is about the outstanding current assets as on outstanding loans as on the date of balance sheet. But if we see CARO 2020, then it mentions that it is about the loan which are taken during any point of time during the year. So to align with the CARO 2020 requirement, these disclosures are there. So if there is any loan which is not outstanding as on 31st March 2022, but that loan is there, but that loan was there during the year, and on account of that loan, the company was required to furnish details to the banks or to the other financial institutions for the current assets, that are the stocks, inventories, book debts, or any other current assets. Then also the reporting requirement is there. So one must see not only on the basis of outstanding loan as on the reporting date, but on the basis of loans which are taken during the period, or the loans which were continued from previous period but have been paid during the period. For those loans also, such reporting requirement is required to be seen in the balance sheet. Then what disclosure requirement is there is with reference to the quarterly returns. So as per bank's sanction letter, the auditee may require to submit monthly returns of its book debts, its inventory or other current assets, but auditor or the management is required to disclose the reconciliation of quarterly return only. and not the monthly returns. That one need to see. And these current assets may include the submission of stock statement, submission of book debts and statements, then aging analysis of debtors, and then other recoveries, other receivables. So here there may come various challenges while reporting the uh, reporting under this particular clause. So the challenges may come like, suppose uh, for March 2021, the balance sheet have been finalized in the September 2021, on say August 2021 or September 2021, and during this period uh, the company have submitted certain stock statement or certain debtors to uh, the lenders, to the borrowers, and to the financial institutions. But later on, when the balance sheet have been finalized, when the financial statements have been finalized, certain debtors which have been reported by the uh, company to the banker as good debtors have been actually treated as bad for the financial statements for the financial year 2020-21 itself. That means in September 2021, when financial statement have been finalized, the debtors have been taken at a lesser amount because some of the amount have been treated as bad debt and the same have been written off. Whereas since the debtors have been given to the bankers in the before the finalization of the balance sheet, they have been given at a inflated figures because no provisions or no write-off was made during that period. So one may find that as per the books of accounts, while auditing the financial statements for 2021-22, say suppose June 2021 quarter quarterly statement have been furnished by the company to the auditors, wherein these written off debtors have been considered as good debtors as per the uh, by the company as per the books of accounts which are then there. So there will be a difference between the debtors as per the books of accounts which are lower as compared to the debtors which are higher in the statement submitted to the bank. So if that reconciliation difference is there, then management should write that what is the reason of such difference. They have to actually give a reconciliation that these have been written off while finalizing the balance sheet, and therefore same were not considered at this time. So these practical issues may come at the time of finalizing the balance sheet for financial year 2021-22. And then there may be certain possibilities where actually the bankers, the borrowers have tried, the companies have tried to actually give certain figures which are not in line with the books of accounts, and by giving say inflated figures, the the company have taken certain higher limits from the bankers. So if such is a case which is found during the course of audit, or in that case the auditor need to see whether such case may fall into the category of fraud or not as per section 447. And obviously if certain wrong statement have been given by the company to the lender, and basis that the loans have been taken, so in that case, since it is a misrepresentation by the company to the bank, this should be considered as fraud by that particular company on the banks. And moment it is fraud, then apart from this disclosure, now again consider that what will happen for the requirement of section 143(12), where auditor need to report on the fraud, and what will happen to the other formalities which are required to be done by the governing audit committee of the bank or other governing body of the of that particular company, not bank. So, and then suppose it is such a case whether there is any other implication with reference to the additional liabilities on the bank, on the company, and then ultimately any implication on modification of report as per SA 705. So please mind that these issues are not only the simple reporting as per SA 50, as per schedule 3, but there are a lot of other implications while reporting, as well as there may be various governance issues also which need to be there may be issue related to the internal financial control. Moment you find that there are certain discrepancies in the bank statement as well as in the statement as per books of accounts. Now coming to the working capital limit above rupees 5 crore. So if we see these disclosures are not only for above rupees 5 crores, but for all borrowings where any management has any company has taken. But so far as CARO 2020 is concerned, it is about wherever working capital limit has been taken above rupees 5 crores on the basis of security of current assets. So what is disclosure requirement? Whether during any point of time of the year the company has been sanctioned working capital limits in excess of 5 crore rupees in aggregate from banks or financial institutions on the basis of security of current assets, whether the quarterly return or statements filed by the company with such banks or financial institutions are in agreement with the books of accounts of the company, and if not, give details. So here few of the pointers which I have already discussed, and the points which have not been discussed will be discussed only. The auditor is required to consider the working capital sanction limit and not its utilization. So it is not about that the outstanding should be more than 5 crore. If the sanction limit is more than 5 crore, then this particular clause will be applicable. Then the clause does not require reporting where such limits are unsecured. So that means there is no security on the basis of current assets, or which are secured or which are sanctioned on the basis of security of assets other than current assets. So suppose any property, plant and equipment have been kept at security, so there this will not be applicable. So both fund-based and non-fund-based credit facilities availed by the company should be considered for the purpose of checking this limit. Not only the fund-based, but as well as the non-fund-based limit should also be considered. Then this quarterly statements I have already discussed. Statements and this. One thing is, one point is, say, about the aging analysis. Suppose oral debtors are matching while furnishing the financial statements, while furnishing the details of debtors to the bankers. But if we go through the aging analysis and we go through the statement submitted to the bank, and we see that what company have done is that most of the debtors they have kept as less than 6 months, and accordingly they have availed higher credit. Whereas while scrutinizing, if the auditor have found that out of these reported debtors to the bank, there are many debtors which are having a different aging. say more than 1 year or more than 3 years. So in that case, also one can say that, of course, the total amount of debtor is matching with the amount which has been shown in the books of accounts. But this aging analysis is not matching. So then that is also required to be reported over here. It is not so that only the debtors to debtor, if they are tallied with, it is over. One need to see that aging analysis is also reported properly. So that is the duty which has been casted upon the auditors to see. Then basis of preparation of such returns or statements by the company from the books of accounts should be evaluated by the auditors. Whether such returns or statements filed by the company with such banks or financial institutions are in agreement. Anyway, this we have discussed. So most of the other points we have discussed with reference to submission of stock statements and book debts to the bankers. Yeah. Now another disclosure which is there is with reference to disclosure of relationship with the stock of companies and the disclosure of transactions and balance outstanding with such stock of companies. So if we see in last few years, lakhs of companies have been struck off by the all 24 ROCs of the MCA. All 24 ROCs have struck off lakhs of companies in last few years. And recently, I think one of the news was there related to the struck of more than 2.5 lakh companies, around 2.82 lakhs companies. So, and actually consolidating the data of these companies is also very cumbersome job. Whereas the MCA have required that where the company has any transaction with these stock of companies, they have to disclose the name of the stock of company, then what is the nature of transaction with that stock of company, and then what is the balance outstanding and relationship with the stock of companies, if any. Suppose they are promoters, say promoters or related parties, JV, associates, that relationship is also required to be disclosed. And these are the categories, whether there is any investment in securities, whether these stock of companies are receivables or payables, whether there are any shares held by stock of companies in this company, or any other outstanding balances that need to be disclosed. But if we see that what are those, how to identify these stock of companies, I would just take you through this public notice, this particular website, and you find that these websites have various public notices which are being issued. And then say recently on 12th of April 2022, the Delhi ROC have struck off, given a notice, and they have struck off number of companies. I will not go into the further details, otherwise all PDF can be downloaded. And if you see that how many results are coming, then in fact there are almost 5 results on each page, and there are 183 pages. So almost 183 pages into 5. So around 900 notifications are there by various ROCs, and all these 900 notifications have, you can say, each notification may have 20, 25, 50, 100 of companies which are struck off by these notifications. So, and all these are basically a kind of compilation which is required to be done. So here I would rather request, because WIRC is a forum wherein I would request chairman also that please ensure with the Ministry of Corporate Affairs that a proper list of stock of companies is published, so that the companies as well as the auditors may actually comply with this requirement. Otherwise, it would be very difficult for a company to find out the stock of companies, because going through each and every notification, which two are basically scanned PDF, and then looking to the records of the company, whether the ledger account which are there in my books, is there any company which is struck off or not? So a lot of practical issues will come for any of the company as well as the auditor to identify and report it. And then not only that, suppose any company is struck off and it comes to the notice of the management, then they have to actually update their software and tag such companies as a struck off companies. So these things are there, these challenges are there, which need to be considered, and I hereby through WIRC request that please work
Yes,
on
sir.
this. Yes, yes.
Yes, sir. We will do that. We will
Yes.
consider your
Yes.
request in that.
Because it is actually very challenging.
Yeah. Your advice is taken care of.
Then there are certain changes related to. I think I should take around 30 minutes for question and answer, or what? What is the view of organizations?
मिश्रा जी कितने क्वेश्चन आए हैं जरा बताएंगे? मिश्रा जी क्वेश्चन कितने हैं? हाँ सर, एक्चुअली इट डिपेंड्स ऑन द क्वेश्चन, हाउ मच क्वेश्चन वी आर गेटिंग.
15-20 क्वेश्चन है, वो लास्ट में लेते हैं, सर को बोला है.
हाँ तो सर
I think-
कोई 15-20. If there is a 15-20 questions, sir, we should keep half an hour for question and answer session.
Yeah. So I will close by 7:30-35, and then
Yes, sir.
yeah. Okay. Yeah. Then there are certain disclosure requirements related to where any charges or satisfaction yet to be registered with the Registrar of Companies beyond the statutory period, details and reasons thereof shall be disclosed. So here also again a very important aspect which we also see during the course of our audit. Suppose if any charges have not been registered, one thing is this, and if there is any satisfaction of charges, suppose loans have been repaid, but the satisfaction of charges have not been done with the ROC, respective forms have not been filed, or whatever formalities are there that have not been done. So then that should also be disclosed, because in fact in one of the case practically I have also seen that the company has company in earlier years had lot of loans, and they have been repaid, but still if we see ROC records, then they say that final satisfaction have not been done over here, and still the charges exist. So though there may not be any financial liability on account of that, but still since charges exist, there may be some or the other issue on any other day. So if these charges are also there, though they are actually satisfied, then the reporting should be there in the schedule 3 in the financial statement, and reasons should also be disclosed. Then where the company has not complied with the number of layers prescribed under clause 87 of section 2. So in fact, as you all know that as per section 186, 2 layers of companies are allowed, that a company can invest into the one company, and that company can further invest in the other companies. But further downstream companies are not allowed as per the Companies Act. So if it is so, then disclosure requirement is there in the financial statements. Then there are disclosure requirements related to various ratios. So the company has to disclose various ratios, and if we see these ratios, as well as if we see the SA 520, that is on analytical procedure. So that also basically provides a lot of things about doing certain analytical procedures, and wherever there are deviations, then that should be actually properly documented by the auditors while doing the audit. So now management have to actually disclose the various ratios in the financial statements, and if there is any deviation which is more than 25%, then that deviation should also be disclosed by the management itself in the financial statements. And these are basically the ratios. Detailed formula of and detailed formula as well as the terminologies are also given in the guidance note. I have just summarized that. So current ratio, debt equity ratio, DSCR, return on equity, inventory turnover ratio, trade receivable turnover ratios, trade payable turnover ratios, net capital turnover ratio, net profit ratio, return on capital employed, return on investments. So these are required to be disclosed over there, and they have been further elaborated in the guidance note, which one can refer. And certainly, there may be certain interpretation issues also, that what should be included in a particular particular term and what should not be included over here. And if there is any confusion, it is better that whatever has been assumed by the management, that yes, I treat this as current asset, therefore this have been treated as current asset in the while computing this particular ratio. So that can be further elaborated in the notes itself, that how a particular ratio has been calculated. So that there is no ambiguity as to that. Then there are certain disclosures related to the scheme of arrangements, which is required to be basically disclosed. Disclosures related to utilization of borrowed funds and share premium. So if they have been invested somewhere else, and then they have further invested to the another companies with the different layers. So the ultimate beneficiary is the company itself, or if there is any funding party, then the clause B is related to that funding party. That funding party is the ultimate beneficiary of such investments, amounts which has been given to the other parties, or such guarantee or security has been given to the other parties. So in that case, a reporting requirement is there by the company itself, that who is the ultimate beneficiaries of such transactions which are done by the company. Then there are disclosures related to the cryptocurrency as well as the virtual currency, which are required to be given by the companies in the financial statements. Of course, this cryptocurrency, again, a lot of issues are there under the taxation, as well as further issues related to the validity of the cryptocurrency transactions are also there. Though Supreme Court have said that yes, companies can invest into the cryptocurrencies, but at the same time, RBIs as well as the government, they all are basically coming out with various laws and regulations with reference to this. Under the income tax law also, there are provisions related to the deduction of tax at source. So at the same time, if any company have made certain investments into the cryptocurrencies, so any profit or loss on such transactions should be reported over here, as well as what cryptocurrency have been held by the company should also be reported over here. So I think a detailed scrutiny would be required, or a detailed examination would be required if any of such transactions are there by the companies in the books of accounts. Then there are disclosures which are required to be about the undisclosed income. So it is about that any transactions which are recorded in the books of account and that has not been surrendered or disclosed as income during the year in tax assessment. or under the Income Tax Act, then that should be disclosed over here. That yes, in assessments we have accepted these incomes, but same have not been disclosed in the books of accounts. So that is required to be disclosed. And in CARO 2020 also, the similar disclosure requirement with reference to undisclosed incomes are there. I have mentioned various points over here, but since we have to close by another 10 minutes, we'll be approaching to the another disclosure. Then disclosure related to the CSR are also there, wherein one has to give disclosure of amount required to be spent by the company during the year, then amount of expenditure incurred, then shortfall at the end of the year, then total of the previous year's shortfall. So cumulative shortfall is also required to be disclosed. Then reasons for shortfall. So if any reason is being mentioned by the management for the shortfalls, auditor have to make proper inquiries that whether such reason is sufficient and appropriate or not. Then what are the nature of CSR activities which are being carried out? Then what are the details of related party transactions? That is, suppose any contribution is being made to a trust which is being controlled by the company itself, then in relation to that CSR expenditure, then such details are also required to be mentioned over here. Then where a provision is made with respect to a liability incurred by entering into a contractual obligation, the moment in that provision should also be disclosed over here separately. Then these are the disclosure requirement as per Schedule 3, and here as per CARO clause 320A, auditor is also required to disclose whether in respect of other than ongoing projects. So it is other than ongoing projects, the company has transferred unspent amount to a fund specified in Schedule 7 to the Companies Act within a period of 6 months of the expiry of financial year, in compliance with second proviso to subsection 5 of Companies Act, section 5 of the section 135 of the Companies Act. So if any amount which has not been transferred over here and which has been actually unspent should be reported over here, that yes, proper compliance have been made or not. These are the certain provisions related to the CSR expenditures, which one needs to actually see. Then another is clause. Next clause is amount unspent on other than ongoing projects. Sorry, on the other than ongoing projects, and this is on ongoing projects. Sorry, heading is not properly given over here. Pursuant to whether any amount remaining unspent under this and this section, pursuant to any ongoing projects, has been transferred to a special account in compliance with the provision of subsection 6. So you all know that recently certain provisions have come that if any amount which has not been spent should be transferred to a special account, and if such thing have not been done, then that has to be reported over here related to the CSR activities. So these are certain provisions where I have tried to basically align various reporting requirements as per Schedule 3 as well as reporting under CARO 2020. And apart from this, there are certain other clauses also where there is a reporting requirement under CARO 2020. So briefly, I will touch upon those changed requirement. There are certain requirements where there is no change, and there are certain requirements where there is new reporting. So I will be more focused on the new reporting for next couple of minutes. So one is about the maintenance of proper records of PPE. So here basically this clause B is about whether the company is maintaining proper records showing full particulars of intangible assets. So earlier, the auditor was required to comment only on the property, plant and equipment, register whether proper records have been maintained or not. But now, comment is also required to be there on intangible assets. So, management of the company have to actually maintain the proper records of the intangible assets. So, if any acquired intangible asset is there out of the market, or say, suppose because of the Ind AS there is any intangible assets which has been acquired due to business combination, or there is any intangible assets which has been acquired because of the grant, government grant received from the government. So the company is required to maintain a record where what is the nature of that particular intangible assets, what is the description of that particular intangible assets, amount which has been capitalized, amount which has been amortized, what is the useful life of that intangible assets. So all these details are required to be maintained by the, and if there are suppose any other document, say any document from any authority issued by the any company, say any licensing authority or any authority where patents, copyrights, etc. are being registered. So those details are also required to be mentioned in such register. And auditor need to examine whether such record is proper or not. And if not proper, the auditor have to take a judgment and report it over here in the CARO 2020 report. These are the details related to the PPE which can be there in the records. Then another clause is related to the physical verification, inventory and working capital management, physical verification of inventories. So it is a revised reporting. Earlier in CARO 2016, material discrepancies were to be reported. Now in reference to CARO 2020, any discrepancies of 10% or more in the aggregate for each class of inventory has to be reported under this clause. So this is the change which is there under clause related to the inventory. So I'm not discussing in detail the rest of the things, but yes, here SA 501 also plays an important role. That how do the management actually set the controls and systems for the purpose of physical verification need to be evaluated by the auditors, and auditor have to also see have the test count during the physical verification conducted by the company. So based on that, the reporting should be there in the this CARO 2020 clause 3 to 8. So that is one requirement. Now another reporting requirement which has been changed is related to the fraud. So whether any fraud by the company or any fraud on the company has been noticed. So here the reporting is that the change in reporting is that CARO 2016 was only with reference to the fraud by the employee on the company, but CARO 2020 has increased the scope of fraud by anybody and is not limited to the frauds by the officers or employee of the company. So that is one change. Then another change is it is a new reporting, in fact, whether any report under subsection 12 of the 143, section 143 of the Companies Act has been filed by the auditor in form ADT4 as prescribed under Rule 13 of the Company's Auditor and Auditor's Rules. So, auditor first need to assess whether there is any violation, and if it is so, then need to see whether ADT4 report has been filed or not. That has to be seen. Then one reporting is related to the whistleblower complaints. So here in whistleblower complaints, auditor needs to see whether the auditor has considered, and whether such complaints are received during the year by the company or not, that has to be seen. And this is the format which need to be maintained by the company and reported by the auditors. Date of receipt of the complaint and mode of receipt, brief description, standards of such complaints along with her relationship with the company, and then how such complaints has been addressed, whether such complaint is indicating any fraud or indicating fraud on the company or by the company, and if yes, what are the further steps taken by the company. So clause is simply that whether auditor has considered or not, but these are the formats which auditor need to actually see whether maintained by the company or not. These are requirements about the reporting of the fraud by the company to the MCA. Then there is no change so far as related party transactions are concerned about the compliance with section 177 as well as 188 of the Companies Act. Then here comes a new reporting requirement, whether the company has internal audit system commensurate with the size and nature of its business. So that is one new requirement. And if you see CARO 2003, then such requirement was there, but in CARO 2013 this requirement was not there. Then whether the report of the internal auditor for the period under audit were considered by the statutory auditor or not. So again, first of all, auditor have to see that whether any any internal auditor out of the company have been appointed by the auditor by the company or not. And if as per the requirement of the Companies Act, section 138, if it is not being appointed, then that aspect need to be considered. And if appointed, then auditor should ask for the relevant report of such statutory auditor and should consider that what scope have been drawn by the management for the purpose of such audit, whether such scope have been covered by the internal audit or not. And if audit finds that yes, there are certain discrepancies even in internal audit, then auditor has to actually draw his final report basis that maybe that there are other implications in CARO as well as the main report. Then non-cash transactions with directors, there is no change in this particular clause. In NBFC related clause, apart from the one clause, clause A, these three clauses have also been added over here. Whether there is a valid certificate for carrying out the NBFC or housing finance activities, that has to be reported. Whether the company is a core investment company, so then again there are certain criteria for to be a core investment companies. And whether the group has more than one core investment company as part of the group, and if yes, indicate the number of core investment companies which are part of the group. So these are the three additional requirements apart from the first one for the NBFCs. Then whether the company has incurred cash losses in the financial year and in the immediately preceding financial year, and if so, state the amount of cash losses. So for computing the cash losses, you have to actually add or deduct all non-cash items which are there in the profit and loss account, and then accordingly see whether there is cash loss or not. And if it is cash loss, then it should be reported over here for this year as well as immediately preceding financial year. Yes, this is again very important aspect, resignation of the statutory auditors during the year. So whether there has been any resignation of the statutory auditor during the year, if so, whether the auditor has taken into consideration the issues, objections or concerns raised by the outgoing auditors. So basically, for last 2 to 3 years, I have seen, particularly in many listed companies as well as the other companies, auditors have resigned for various reasons. And some of the database of MCA has actually pointed out that these reasons are not up to the mark. Some reasons are like they are preoccupied. So you can say that these reasons are not relevant reasons. So as and when any statutory auditor is resigning, and as a new auditor, suppose another firm is accepting, so another firm has to actually take due care and actually should inquire into such resignations even before the acceptance. Because once you are accepted and later on you find that there are certain challenges in accepting and in conducting the audit of such company, so the new incoming auditor may actually come into the trouble. So please mind that proper care is being taken, and in this regard, the our institute has also issued a guide that how to deal with the resignation of statutory auditors. So that guide should also be considered by the firm for the purpose of accepting the assignment of new audit. And if the auditor have properly dealt with all these issues, then auditor should report, yes, all the necessary things have been properly considered while dealing with the resignation of the statutory auditors. Then here, basically, again, an important aspect, material uncertainty exists on the date of audit report to meet existing liabilities at the balance sheet date due within 1 year. So basically, auditor has to not only audit the AY financial year 21-22, auditor need to also see and also report for next 1 year whether the company will be able to pay off its existing liabilities which are due within the next 1 year. So for this, in fact, again, it is a if one has to discuss on this particular point, it may take another 1 year, one hour. That how he will actually assess how he will actually examine to the cash flows, what are the future cash flows which are going to be there, and of course this is something which may be even beyond the standards of auditing, because the standard of auditing does not say that auditor need to, of course, SA 570 is there, which is there on going concern. So I would not say that it is not at all covered, but to actually estimate that whether they will pay it within 1 year or not, so far as existing liabilities are concerned, may be somewhat may not be into the auditor's purview, but still the reporting requirement is there under the CARO 2020. So proper reporting has to be there, and of course in question answer I would deal with such thing also, because there may be one or two questions on this. Then in consolidated financial statements, so basically auditor have to report whether there have been any qualifications or adverse remarks by the auditors in company's audit report, audit reports of companies included in the CFS. If yes, then indicate the details of companies and the para number of CARO report containing the qualifications or adverse remarks. So this is a new reporting. So basically on CARO, you need not to give the, on consolidated financial statement, there is no requirement of issuing a CARO report. But in the CARO, on the standalone itself, suppose there are certain matters which are there reported by the component auditors in their CARO report, then that has to be reported over here if there is any qualification or adverse remark. So this qualification doesn't mean the qualification as per SA 705. It should be a kind of qualification related to those specific points which are there in the CARO 2020. And if there is any adverse remark, then that should also be reported. And only a reference of the para number of that CARO report of the component auditor is required to be given over here. and not that you have to reproduce the full text of point which has been reported by component auditor. So this is one thing. And now this use of accounting software, which was earlier made applicable with effect from 1/4/2021, then has been postponed for 1 year to be effective from 1/4/2022, have now been further postponed to be effective from 1st of April 2023. So there is a relaxation to all companies that they have 1 more year's time to implement this particular amendment in the softwares, in their software where they are maintaining their books of accounts. So this is all about from my side. I would now take the various questions, and before taking those queries, I would rather say that these are the certain amendments. Though there are challenges, but at the same time, I would I am of the view that these challenges would rather strengthen the independence of a particular auditor, because there are various disclosure requirements which now the company themselves have to report. So the law itself requires that yes, not only in the CARO, but you have to also report that these are the discrepancies. And apart from that, once you have to also report in the CARO, which is a mandatory reporting requirement, no one can actually escape. So for all good reasons, we can communicate to the management that there is no nothing which is in fact possible over here to hide off and all these things. So management can also not put any pressures on the auditor, because these things are actually now mandatorily required to be reported by the auditors. So now about
Sir,
yeah.
question is displayed on the screen. If you can read, or I will read for you, whatever you like.
Yeah, I just for the sake of rest of my thought, you can please read.
Yeah, sure, sir. First question is, for a private company, earlier CARO was applicable as revenue reserves were over 1 crore and CARO reports was issued. Now, since it falls under a small company revised definition, would CARO be not applicable at all?
Yeah, in fact, CARO will not be applicable, because if we see those exceptions, then in exception, the small company, there is a separate there is a separate clause, and then private companies, there is a clause with conditions. So if any private company is falling into the definition of a small company itself, then this particular clause will not be, the CARO will not be applicable over there. Yes.
Okay, sir. Second question is it mandatory to round off to nearest 100 or 1000 for a small company? Also, total income less than 100 crore, of course.
Total income less than
100 crores.
Yes. Now it is a mandatory requirement to round off, because the Schedule 3 does not give any exemption to the small company. So, and they have replaced the word may with the word shall, and which was actually earlier there in the Division 2 also, that word shall was also there in Division 2. So for small companies also, the rounding off requirement is there.
Okay. On rounding off, absolute figures are mandatory to be rounding off in 100 and not absolute now. For example, revenue of rupees 1 crore 25 lakh 63,981 would be rupees 125,640 in hundreds and not absolute in decimal rounding off. Please confirm.
On rounding off, absolute figures are mandatory to be rounding off in hundreds and not
in 100
absolute.
And not absolute now. Yeah, it's correct. Now it should
For
If
example,
it is in 100,
okay, they are saying that decimal is not required.
yes,
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 I think
yes.
it is correct. Yes. Then yeah. Next is making of provision for expense and unbilled dues is the same. So no, I think making of provision for expense and unbilled dues, yes, that can be same, because here something where you have actually not received the bills, and therefore you are actually making the provisions. So we can say that it is unbilled dues.
Okay. Next question is, sir, kindly explain the concept of significant increase in credit risk in case of trade receivable. As an auditor, we have to obtain MR from the management.
Yes, I think it is better, because see, again, it is very subjective whether there is increase in credit risk in case of a trade receivable or not. So first of all, as I explained, that Ind AS 109 requires that do not require the individual assessment of the credit risk for each trade receivables. So there is, but at the same time, if company feels that yes, there can be an individual assessment, then that should be there by the management. And yes, the MRL should also be taken with regard to this.
And I think better to take all the things for in MRL. Nothing
No,
could
no.
be left out.
See, MRL cannot be actually be the replacement of the audit evidence. MRL is just to
Yes.
support the audit evidence. So you need to
Correct.
actually, whatever workings are there with reference to the credit assessment or with reference to the expected credit loss which is being done by the management, that has to be properly weighted. But at the same time, a support can also be taken from by the MRL.
One incident I want to share with you, if you allow, sir.
Yes, sir. Yes. Yes, ma'am.
We are the statutory auditor of one of the divisional office of New India Assurance. Okay, so in that audit report, we are giving that we had received the that no director is any disqualified to appoint again. So they had issued us the MRL that none of the director is disqualified to reappointment for reappointment. When I asked the branch head, sir, how you come to know that if you don't know who is the director right now?
Correct.
When I ask you, and you are giving me MRL that none of the director is disqualified. So
That's correct. So MRL cannot replace the audit evidence, in fact.
So when I asked him that you should take that with your HO or RO, that how you can sign and give me this document in the writing that none of the director is disqualified, because you had no any evidence for that. Then he asked the HO. HO had given him the certificate to him, and then he gave MRL to me. So.
Correct.
Yeah. And so next question is, lease deed of government allotted lands are not required to be disclosed in CARO. Please confirm.
Yeah, in fact, if you
government.
see clause 31C, it says whether the title deeds of all the immovable properties other than properties where the company is the lessee and the lease agreement are duly executed in the favor of the lessee, disclosed in the financial statement, are held in the name of the company. So yes, the clause itself excludes, itself says that those immovable properties which are other than properties where company is lessee. So this is not required to be considered for the.
So if the government allotted is the lease deed is there, so in this case disclosure is not required.
Correct.
Okay. Each balance sheet format change from financial year 21-22 or 22-23?
21-22, and that is why in fact we are discussing, because we are always late so far as
correct.
if it would have been 22-23, probably we would not have organized the seminar today.
No, we have to organize because we have to many things are we have to maintain from
Correct.
1st April.
Correct.
So for that purpose we have to
And
organize.
in fact, looking to past 1 year, it should have been organized. So many of seminars should have been organized from April 2021 itself on this particular aspect.
Sir, what
Because
sir
there are a
what
lot of
happened ना अभी लोगों को सर अभी लोगों
but
को आदत पड़ गई कि लास्ट मोमेंट पे आके ना वो एक्ट अगले साल के लिए डेफर हो जाता है।
correct, correct,
तो
correct.
लास्ट मोमेंट तक दे आर वेटिंग कि मे बी कि ये भी अगले साल के लिए डेफर हो जाएगा।
नहीं
बट नॉट अ थिंग, जो भी अर्लियर इज द बेटर। तो सर कैन यू शेयर प्रैक्टिकल इंस्टेंस ऑफ अनबिल्ड रिसीवेबल एंड पेएबल?
Yes, in fact, say suppose we are into IT industries, and then there are a lot of you lot of there are a lot of instances where you see that work have been done, and there have been there has been no issue of the invoice because of the terms and conditions with the respective customer, that you cannot raise the invoice. But so far as India's 115 is concerned, because of that, one can recognize the revenue over a period, over the time, and even under AS9. So if it is so, then one can recognize the unbilled receivables also. So they are considered as unbilled revenue, in fact. Similarly, the case may be with payables also.
Okay.
In many of the
Whether
electricity companies, I see that there are unbilled revenue which are being recorded because of the order of central electricity regulatory commissions or the respective state regulatory commissions. Unbilled revenue are being recognized, and they are being later on billed basis the directions of the these regulatory authorities. Yes.
whether to show all line item in Schedule 3 or only applicable clauses?
Yeah, in fact, Schedule 3 does not mandate. Suppose some line items are not there, then one can actually remove those line items. But see, many times such questions comes ki sab, suppose the company do not have any property, plant and equipment, should we report or not? So for a better disclosure purpose, I think one should report. But
So line item should be there, and line item should be there, and we can write 0 or nil like in front of.
Yeah, and there are, see, there is some practical issue that while reporting in the XBRL asks for certain mandatory line items, that yes, debtors are 0 or not. So suppose any company do not have trade receivables, uska sara case ka kaam hai, and then there are no trade receivables. But since XBRL says that it is mandatory to report trade receivables even if it is nil, so it is better that we at least report those line items which are there in the XBRL, so that there is a proper, you can say, facilitation between reporting in XBRL as well as reporting in financial statement. Yes.
Okay. Next question is, in case companies are giving monthly stock statements to the bank, and in most of the cases figures are not matching with audited balance sheet figures, company is not required to submit quarterly statements. Whether in this case auditor is required to report? This is
नहीं,
common
आप
problem,
समझिए,
sir.
अरे नहीं, आप समझिए, अगर मंथली स्टेटमेंट सबमिट हो रहे हैं तो क्वार्टरली तो जिस तीसरे मंथ में क्वार्टरली हो जाएगा ना वो, तो आपको फिगर तो एज ऑन डेट देने होते हैं स्टॉक स्टेटमेंट्स के, तो जो थर्ड मंथ का फिगर होगा दैट विल बी क्वार्टरली. आपके जो डेटर्स आपने तीसरे मंथ में दिए वो क्वार्टरली डेट के स्टेटमेंट है. तो
नहीं तो सर यदि हमारी ऑडिट रिपोर्ट से 31 मार्च की ऑडिट की रिपोर्ट से या हमारी फाइनेंशियल से उन लोगों ने जो सबमिट किया हुआ है 31 मार्च का फिगर वो यदि मैच नहीं कर रहा होगा, देन वेदर वी हैव टू रिपोर्ट.
यस, अगर नहीं है तो वो रिपोर्ट भी करना पड़ेगा. और मैं आपको जैसे बताया अभी, इफ देयर आर variations and they are not properly explained by the management, suppose inflated figures are given and all that, so then you need to consider whether to qualify or not. You need to consider section 143(12) also. So huge responsibilities are there once there are discrepancies in the stock statement submitted by the company to the bankers.
So, sir, my question is, stock statement include debtors figures also, creditors figures also,
Sorry,
WIP, all this.
if I am saying about stock statement, this particular clause is about the current assets, not only stock statement. It is about the current assets. So
Yes.
when we see the bank sanction, so if bank says that current assets should be there, or bank specifies that stocks, debtors, other current assets, so then all current assets need to be considered. If suppose as per sanction only bank statements are required to be submitted, other debtors are not submitted, then that has to be seen. So it depends.
One more question. Sir, one more question is from my side कि जो ये कुछ वेरिएंस एक्सेप्टेबल है कि 5% या 10% का वेरिएंस रहे तो नहीं करना है वैसा कुछ?
No variance is acceptable. Only thing is, suppose, see, as per books there is more stocks, and as per what you have given is lesser stocks, and sometimes certain situations may come that company has 5 units, and the loan has been taken only for 1 unit or only on the basis of one of the stock of one of the units, and as per sanction also all these things are evident. So then overall books of accounts may be higher, and as per the stock statement of that unit, the stock may be lower. But you need to see only that stock which has been offered for offered as security to the bank. So जहाँ कहीं कुछ lower हो रहा है तो okay है, but suppose things are reasonably explained and you find it's overall okay, and there is no harm to bank, there is no overdrawn of the funds from the bank, then you may consider not to report. So a judgment is required to be taken.
Okay. In case of ratio, return on capital employed, wanted to know whether shareholders' equity will be only equity share capital or it includes all the reserves. I think it includes reserve also.
It will include reserves.
Ratio. Yeah. Any amendment for LLP in comparison of last year? What is the treatment of company received government subsidy?
I think LLP में financial statement changes में I am not aware, but शायद कोई specific change नहीं होंगे. And so far as company received government subsidy, तो AS 12 या Ind AS 20 के हिसाब से चलेगा. Whether it is a revenue subsidy towards the revenue, then it will be accounted for as income, or if it is towards the asset, then it can be either reduced or it can be say first credited to the revenue liability account, then can booked as income under the as in proportion to the depreciation charge. So these are, but though it is not related to the today's seminar.
Yeah. Next question is what I had asked now, director disqualification to be confirmed from director himself. Yeah, DIR 8 is there, na? DIR 8.
Yes.
Ratio on return on equity ratio. Equity will be only equity share capital or it include all the reserves. Actually, earlier he.
This has already been answered.
Yeah. If management is giving assurance on meeting existing liability in next 1 year based on collection plan or upcoming in case increase in sanction loan, in this case, what to be considered?
Upcoming
increase in sanction loan. मतलब कि वो जो उनकी जो भी लाइबिलिटी है वो बोल रहे हैं कि 1 साल में हम खत्म कर देंगे, हमको सैंक्शन जो लोन है वो ज्यादा अमाउंट का सैंक्शन होने वाला है, तो लोन से हमको
होने वाला है तो आप चलोगे नहीं ना. अगर आपको लगता है कि आउट ऑफ द प्रेजेंट कैश फ्लोज जब तक वो होने वाला है तब, और देन अगेन आई थिंक ये अगर वो लोन लेके ही लोन चुका रहा है तो कहीं ना कहीं आई फील दैट देयर में बी ए क्वेश्चन ऑन मीटिंग द एक्जिस्टिंग लाइफ. But yes, only I would
Existing
again
liability,
see. I
yeah,
would
existing
again say
liability means only loan or expenses also. I don't know.
all existing liabilities. See, what is the clause? I would just read it again. On the basis of financial ratios, aging, and expected dates of realization of financial assets and payment of financial liabilities, other information accompanying the financial statement, the auditor's knowledge of the board of directors and manager plans, whether the auditor is of the opinion that no material uncertainty exists as on the date of the audit report that company is capable of meeting its liabilities existing at the date of balance sheet as and when they fall due within a period of 1 year from the balance sheet date. So it is not about only bank liabilities. It is all current liabilities which are there due within 1 year.
So it is a question is included if few transactions are disputed of same company, all amount considered as disputed, or how to identify strike of parties.
I think strike of parties, I have already flagged off the issue कि it is very difficult क्योंकि MCA की website पे अगर अपन देखते हैं तो there are around 183 notifications, sorry 183 pages and each page has 5 notifications, internet pages. So more than 900 notifications are there, and which consist around each notification there may be 20, 25, 50 companies which have been struck off. Few of the notifications even more. So and then all these are scanned PDF which are available on this website. I have actually shown the link of that particular website, MCA21. So yes, it's a cumbersome task, and rather institutes should actually, if MCA want this reporting, institute should make a representation that a proper list is being circulated so that management can do this.
Yes. So, and sir, if few transactions are disputed of same company, all amount to be considered as disputed.
क्या बोल रहे हैं मैम प्लीज?
उसमें ये बोल रहे, उसका कहने का मतलब है कि सपोज मेरी एक कंपनी से 10 बिल है आउटस्टैंडिंग, उस 10 में से यदि 5 डिस्प्यूटेड है तो पूरा का पूरा 10 बिल का मैं अमाउंट डिस्प्यूटेड बताऊंगी कि सिर्फ उस 5 का ही डिस्प्यूटेड बताऊंगी?
I think very relevant question. I didn't point out this in my presentation. Yes, whatever amount is due cannot be treated as dispute if one can formally establish that this they are already accepting and for which they are making the payments or they are agreed and they have given the confirmation also, then you should say that this is not disputed. But rather I would say, for the sake of clarity, a bifurcation within the debtors or rather a particular working can also be taken for this purpose with relevant evidence for audit as a audit evidence.
Okay, so we can bifurcate for disputed and undisputed for the same party.
Yeah, if it is clearly established from the evidences.
Yeah,
if there is
with the evidence.
If there is no clear establishment, then I think entire amount should be treated as disputed.
Okay, what about disputed advances and advances from customer? Advances to vendor are disputed.
I think advance disputed, there is no separate reporting requirement is there. Reporting requirement is there for receivables as well as payables, which are disputed. So if we have received any advance from customer, and then who will dispute? Customer, or customer may say that you give us the advance back.
Yeah.
So
Yes.
probably this is otherwise shown as liability in the financial statements. So there is no separate disclosure requirement for advance from customer.
And advances to vendors are disputed. For creditors को advance दिया हुआ है, in that case.
Then again there is no separate disclosure required.
LLP
But one
converted
can
into
consider
company
it for the
this year.
purpose of, say, contingent liabilities and contingent asset related disclosures.
LLP converted into company this year. whether comparative will be required for aging or ratio etc. ये सर बहुत कॉमन क्वेश्चन है क्योंकि बहुत सारी कंपनीज एलएलपी में भी कन्वर्ट हो रही है, बहुत सारी एलएलपी कंपनीज में भी.
Yeah, I think for the companies, this would be the first financial statements as per the company law. So they need not to give. What they can do is a disclosure can be given that earlier this was LLP, therefore no previous year disclosure.
Okay. Whether CWIP aging is to be given on the basis of date on which these are to be capitalized or on the basis of date from which expenses are incurred.
On the basis of date for which expenses are incurred. This I have explained.
Okay. If a company is consulting industry and Schedule 3 Profit and Loss Division 1 format can be modified to reflect consultancy expenses, means direct cost, separately on the face of P&L account instead of putting in other admin expenses.
Yeah, I think for better understanding, one can put a separate line item for consultancy expenses directly.
In P&L first page.
Yeah.
Previous year figure in the current year have been regrouped. Please guide if current year ratio will be calculated based on previous year grouping or as per current year grouping.
No, it should be as per current year's grouping with proper explanation. And see, wherever such groupings are there and these are material in nature, then as per Ind AS 8 would come into picture, where one need to actually restate the opening balance sheet also. So, moment
Yes,
there are reclassification, regrouping, Ind AS 8 should also be considered.
सर ये एक बहुत बड़ी कई बार कंफ्यूजन होता है कि यदि हमने रीग्रुप किया तो अभी प्रीवियस ईयर के फिगर को भी हमको रीग्रुप में ही दिखाना पड़ेगा.
हाँ, करना
तो
चाहिए.
वो बोलते हैं फिर हाँ तो फिर बोलते हैं कि लास्ट ईयर की बैलेंस शीट से फिर वो मैच नहीं हो रहे हेडिंग.
उससे मैच भी नहीं हो रहे और Ind AS में तो then there is different requirement that it should be retrospectively restated, and then there has to be a different opening balance sheet which need to be given.
सो ये थोड़ा कंफ्यूजन रहता है सब जगह पे यदि रीग्रुपिंग हुई तो कि क्या करना चाहिए उसमें.
So as an auditor, one should actually have the relevant evidences as well as reasoning in its audit documentation that why this has happened.
And if borrowing is outstanding in previous year returns also to verify with bank.
Probably not. No, I think this is for current year.
Yeah. If capital work in progress project are delayed due to COVID.
For management reporting purpose, need to check. Probably not, but need to check.
Okay. And sir, last question. If capital work in progress projects are delayed due to COVID, should be considered as suspended?
I think see the documentation that whether yes, I think maybe because of the financial liquidity crunch, this has been suspended, and the management may have decided that we will start it say after 2 years, 1 year. So one need to see that what are the board how board has dealt with such situation, that whether they have agreed कि हाँ इसको हम 2 साल बाद करेंगे, 1 साल बाद करेंगे, or on record if it is not happening, then yes, it should be treated as suspended. Suppose आपका whatever expenditure you have incurred, that is not in, now you are not incurring expenditure in this particular project, so it should be treated as suspended. So judgment need to be taken over this. अगर मान लीजिए कि 1-2 महीने के लिए सस्पेंड हुआ और बाद में वापस सिचुएशंस आर गुड, देन क्योंकि अभी आप देखिए जैसे जनवरी के अंदर देयर वाज कोविड, जनवरी फरवरी देयर वाज कोविड, and because of that maybe that funds could not have been arranged, but March आते आते things are now normal, and in April suppose one have started it again, so one can consider that it was a temporary suspension and not because of this.
He is writing that it is because lockdown,
If it is because
suspended
of
for
lockdown,
2 years.
then I think it should be suspended, treated as suspended.
For 2 years. Okay. So, sir, thank you very much for your answering of query for 22 questions, I think, and your so lucid, your presentation in so lucid manner. Now, I request C. Archika Agrawal to give a family vote of thanks. Please, Archika.
Thank you, Pinky ji, for giving me this opportunity. Sir, thank you very much for such a good session. It was actually very wonderful. You have put entire crux of all the provisions in a small session of 3 hours. And so, and one thing I will say is this with these provisions, the finalization of audit has become more challenging for us now, and has put more responsibilities. As basically, it has extended the area of our disclosures, and really become a bit, not bit, but more challenging and more tough for the auditor to close it. So really, thank you, sir. Thank you it was for giving us your knowledge and for your valuable time. And I thanks the participants also, and for WIRC also to arranging such a good session, sir. Look forward for more sessions like this. Thank you, Pinky ji.
So
Thanks
you
so much,
all
sir.
thank you so much.
Thank you, Mantri ji. Thank you, Archika. And we can close the
Thank you.
session now. Yeah.
Thank you.